Despite recent weakness, the first half of the year has proven to be positive for gold. So can we say the same for the second half? Our next guest seems to think so. Joining us now is Stifel's Chad Morganlander. Chad, welcome back to the show.
Thanks for having me back.
So I know from past talks that you like having exposure in GLD, the world's largest gold-backed ETF. It's come off its peak from earlier this month, but still up on the year. So where do you see GLD headed now?
So I think over the course of the next 6 months that you could start to see higher highs within GLD, perhaps 3 to 4% additional return as the Federal Reserve pivots to become a bit more hawkish. With that said, we think overall from a long-term forecasted perspective, a 4% kind of return on an annual basis is about 2x inflation here in the United States is perhaps what you should be expecting.
Now, your 5-year outlook on the gold price is relatively unchanged from when we last spoke nearly a year ago, looking for 4 to 5% returns. But what do you make of the recent price action we're seeing with gold really unable here to make those new highs?
Well, you have an abnormal low amount of volatility within the financial markets. The financial stress within the system is very low as well. So we think that as that becomes more elevated in a gradual manner, then you're going to get another bid within gold. It's not exactly correlated with the stock market. It's quite the opposite. So we believe, once again, as you start to see risk markets start to get a little more choppy going into next year, that's where you're going to start to see additional upside for gold.
Chad, what about short term, though? With the Fed on track to raise rates this year and possibly reduce their balance sheet, is it still time to be underweight gold?
Yeah, I would be. I think that's actually one of the triggers for financial conditions tightening a bit. So we would expect maybe, perhaps, another 4% total return out of GLD for this year. With that said, we're not extremely bullish, and we would be careful on what our allocation is towards gold. Currently, based off your risk parameters, we would have between 4 and 8%. Our balanced portfolio currently stands at about a 6% allocation towards GLD.
Now, I know in the past you were avoiding gold miners. You prefer the pure play in gold. Does that still hold true today?
Yeah, it does. Yeah, absolutely. The thing about the way that we view the world is that we're looking at gold as an asset class that's not exactly correlated to the stock market or the bond market. When we look at the miners, there's a little bit more of a layer of complexity. Not only do you have to pick where gold is going, but also which is the best management, and as well, are those companies managing their balance sheet very well? Many of those miners have a lot of debt. It's an elevated amount of risk. I would just suggest that if you want to try to get a pure play, you just go with an ETF.
All right, Chad, thanks so much for your thoughts. We'll see you soon.
Thank you.
And thanks for watching this edition of Kitco's Gold Report. We'll be back tomorrow. Hey.